I had started investing when I was 11. It just dithered away until when I was 7 and 8 and 9. So unfortunately, I didn't get started until I was 11. But I bought my first stock when I was 11, and then I experimented with a whole bunch of things, the timing of stocks and charting and doing all these crazy things. It was a lot of fun. Profitless, but a lot of fun. And I did that until I was 19. And I read all the books on investing in the public library and I ate it up. It was fascinating to me, but I had no framework. I was just searching for something. I was hoping that little things on a chart would tell me something about what a stock was going to do. It was kind of crazy, but everybody else was doing it, so I figured I'd do it too. Sometimes you'd turn the chart upside down, it still wouldn't help. Then in 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of him up till then. And there are really only 2 chapters in that book that are the key to it. But they set my philosophical framework for investing.
That's Warren Buffett, one of the most successful investors of all time, known for his disciplined and patient approach to investing. Buffett has built an empire through his savvy investments. Buffett has very simple and straightforward investing principles that he has been using for decades, allowing him to make a fortune. Buffett's investing strategies are easy for anyone to follow for achieving greater financial success. That's why in this video, we'll explore some key strategies that Warren Buffett uses in his investment approach and how you can apply them to your own investment portfolio. With that said, let's get started. Welcome to Smart Investing, where we talk about all things related to personal finance and investing. Strategy number 1, invest in what you understand. Warren Buffett's first rule of investing is to invest in what you understand. He often gives this key advice to people who want to invest money. This means that you should take time to understand the company and its industry before investing in it. If you don't understand how something works, then you shouldn't invest your money in it. For example, if you work in the healthcare industry and you understand how pharmaceuticals work, then it might make sense for you to invest in a pharmaceutical company. But if you don't know anything about technology, then it wouldn't make sense for you to invest in a tech company just because it's popular or seems like it's doing well. This advice is important because it helps you avoid making risky investments based on hype or speculation. If you invest in things you understand, you're more likely to make informed decisions and avoid losing money on investments that don't make sense for you. Strategy number 2, look for companies with strong moats. Buffett looks for companies that have a sustainable competitive advantage, or what he calls a moat. A moat simply means a competitive advantage that a company has over its competitors. Just like a medieval castle had a moat to protect it from attackers, a company with a strong moat has a barrier that makes it difficult for competitors to challenge its position in the market. For example, let's say you're looking to invest in a soft drink company. Coca-Cola is a good example of a company with a strong moat. They have a well-known brand name, a long history of successful marketing campaigns, and they've established distribution channels all over the world. It would be difficult for a new soft drink company to come along and challenge Coca-Cola's position in the market. That's why Buffett did invest in Coca-Cola, making it one of the greatest investments. When you invest in a company with a strong moat, you're essentially investing in a company that has a unique edge over other companies in its industry. This means that the company is likely to continue making profits over the long term, even if the economy or the market experiences some ups and downs. By doing this, you can increase your chances of investing in companies with long-term growth potential. Strategy number 3, focus on value investing. Buffett is known for his value investing approach, which means investing in companies that are undervalued. This involves looking for companies that are undervalued by the market, meaning that their stock price is lower than their true worth or potential. Investors who practice value investing seek out companies that are temporarily out of favor with the market or are overlooked by other investors. For example, let's say you're interested in investing in the retail industry. A company like Target might be a good value investment opportunity because it has a strong track record of success, a loyal customer base, and a solid business model, but its stock price might be temporarily down due to some negative news or a broader economic downturn. This would create an opportunity for value investors to buy shares of Target at a discounted price with the expectation that the stock price will eventually recover and increase in value. By investing in undervalued companies, you can reduce your risk of losing your money or getting stuck with a bad company. And your investment can generate strong returns when the market eventually recognizes the company's value. Strategy number 4, be patient and long-term oriented.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, You expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them.
One of the most important aspects of Buffett's investing approach is his patience and long-term vision. He often holds investments for many years, even decades, allowing them to compound over time. Being patient also means being willing to wait for the right opportunities to invest. It means not making hasty decisions based on short-term fluctuations in the market, but instead taking a long-term view and focusing on the fundamentals of the companies you're investing in. For example, let's say you're considering investing in a company that makes solar panels. You might be tempted to invest based on some positive news about the company's recent growth, but a patient and long-term oriented investor would take the time to research the company's management, its financial health, and its long-term prospects in the solar energy market. This would help you make a more informed investment decision that's based on the company's long-term potential rather than short-term news. Being long-term oriented means having a vision for where you want your investments to be in the future and holding on to them for the long haul. It means not getting distracted by short-term market fluctuations, but instead sticking to your investment strategy and allowing your investments to grow and compound over time. By following this, you can take advantage of the power of compounding and potentially achieve strong long-term returns. Strategy number 5, keep your costs low. Buffett always emphasizes the importance of keeping investment costs low. When it comes to investing, there are many costs associated with buying and selling stocks, such as brokerage fees, commissions, and taxes. These costs can eat into your returns, and over time, they can significantly reduce the value of your portfolio. To keep your costs low, you want to avoid unnecessary fees and expenses whenever possible. This means seeking out low-cost investment options, such as index funds that have lower fees and expenses than actively managed mutual funds. It also means avoiding frequent trading, which can result in higher brokerage fees and taxes. For example, let's say you're interested in investing in the technology industry. Instead of buying individual stocks, you might consider investing in a low-cost index fund that tracks the performance of the technology sector. By doing so, you'll be able to gain exposure to a diversified portfolio of technology stocks while minimizing your costs and fees. This approach can help you maximize your returns over the long term. Even small reductions in fees and expenses can add up over time, resulting in significant savings and higher investment returns. That's it for today on how to invest like Warren Buffett. However, we can keep on talking about Buffett's investing strategies and valuable lessons from them, but let's save that for another day. If you follow these simple 5 strategies, then you can achieve greater financial success. We wish you the best in your investing journey. Remember, investing is a long-term game. We hope that you found this video informative and helpful. Please leave a like to let us know. Comment down which strategy you have been following and which strategy you want to add to the list. Thank you for watching. Don't forget to subscribe to our channel for more great content. And as always, we'll see you in the next one.
Rule number 1, never lose money. Rule number 2, never forget rule number 1.